Greetings friends, I'm here with you. Oleh Ivchenko, head of Pareto company. December is the time when the Christmas spirit is in the air. And even though there's a festive vibe all around, we continue to keep an eye on the main tax events and stay on top of things. In the field of transfer pricing and CFCs, today in the episode, tax authority clarifications regarding documentary audits, updates to transfer pricing rules in Canada, and the ingenuity of McDonald's lawyers in Luxembourg. We'll break all of this down in more detail. Let's go. The tax service of the Kyiv region reminds, if a controlling person submitted a shortened CFC report for 2024, then a full report must be submitted by the end of this year. If, after submitting the full report, it turns out that due to the CFC, the controlling person has additional income that is subject to tax in Ukraine, they must file an amended tax return. This can be either the declaration of property status and income or the corporate income tax return. The tax authorities emphasize there will be no penalties for such amendments. Therefore, businesses have time to carefully and correctly update their reports and actualize the data without the risk of additional sanctions. Canada has announced a major update to its transfer pricing rules. The focus is on Section 247 of the Income Tax Act. It was this section that the Canadian government reviewed together with experts in order to bring domestic transfer pricing rules up to modern standards. The main idea is to strengthen control over transactions between related companies. There are plans to shorten the deadlines for submitting documentation, clarify the approach to selecting the transfer pricing method, and strengthen the requirements for substantiating financial transactions. Ukrainian companies that have transactions with Canada should analyze and take these changes into account now. This will help avoid unnecessary questions and the risk of additional assessments next year. 10 years ago, in December 2015, the European Commission launched an investigation into the tax agreements between Luxembourg and McDonald's. Journalistic investigations revealed that the company paid no taxes, neither in Luxembourg nor in the US, even though it received hundreds of millions of euros in profit from royalties every year. The reason was two tax rulings issued by Luxembourg. The first ruling stipulated that the profit should be taxed in the US, while the second allowed the company not to pay any tax at all, even without proof of taxation in the US. At that time, the European Commission stated that such conditions could violate state aid rules, since other companies did not receive such favorable terms. Interestingly, 3 years later, the European Commission announced its final verdict. There was no violation of state aid rules. The Commission acknowledged that Luxembourg's tax legislation was applied too favorably, but not selectively. Thus, the vagueness of the wording created a loophole that McDonald's took advantage of. Those were the news stories of this week. We will continue to monitor developments in the area of transfer pricing and CFCs and keep you informed. I am Oleh Ivchenko, and the Pareto team thanks you for being with us. We would be glad to receive your comments and feedback. They help make our reviews even more interesting. See you in the next episode of Pareto Point.